Hi, my name is Elliott Gue. I'm the editor of the Energy Strategist, and today I want to talk about the crude oil inventory report released this morning. We're seeing a little bit of a shift in the numbers this week, which is generally a more positive shift for crude oil. Crude oil inventories were unchanged. Expectations had been for an actual build in crude oil inventories. Crude oil inventories are sticking around average, around the 5-year average for this time of year. What had been a little bit concerning earlier in the year and late last year was that inventories have been building at a more rapid than expected pace, and actually a far more rapid than normal pace. That had been something that could have potentially put some downward pressure on crude oil prices. We are seeing a little bit of a moderation of that trend. One key point to look at there is that we are seeing a drop in inventories, or rather in imports, rather than what was the case last year. So it looks like inventories of crude oil into the U.S. have moderated somewhat, and that may help keep those inventories from getting too far out of line on the upside. What remains way out of line, of course, are gasoline inventories in the U.S. Gasoline inventories are way above not only the 5-year average, but also the top end of the 5-year range. We're actually setting new highs there. However, this particular report was somewhat encouraging. We saw inventories of gasoline drop in the United States at a faster than expected pace. What's going on here I think is somewhat encouraging on that front as well. What we're actually seeing is the refiners are cutting back on their capacity utilization. In other words, they're producing less gasoline. They can see that gasoline inventories are very high for this time of year, and refiners are running at about 82.2% of capacity. In other words, they're not running their refineries full out. Earlier in the week, we saw the biggest independent refinery in the U.S., which is Valero, come out and essentially warn on their profits for the quarter. Not really unexpected, because we know that refining margins have remained depressed in a time of year when they typically would rise. However, it's just another indication that they're also cutting back also on their gasoline output, and I think we're starting to see that reflected in the numbers here. Distillates, just really quickly, are actually in the lower half of the average range, and they also saw a larger than expected drawdown in inventories for this time of year. The other important points to note out of the report that I thought were kind of interesting, in last week's report we saw crude oil come off very sharply because of the drop-off in gasoline demand that had been reported over the same period 1 year ago. This week's report was actually a little bit more bullish on that front. Gasoline demand did drop, but only by about 0.3% over the same 4-week period last year. That's really not much of a drop-off at all. Gasoline demand in the U.S. tends to be typically very stable. What had been the concern was twofold. One, that a slowing economy might be hitting demand, and two, going part and parcel with that, of course, is that high gasoline prices might have been choking off demand. That at least doesn't appear to be the case in this week's report. The other interesting point I noticed was that jet fuel demand is actually 1.6% higher than what was the case in the 4-week period 1 year ago. That's kind of interesting when you consider the idea that typically in a slowing economy you would see demand for air travel go down. That doesn't appear to be the case at this point. Heating oil demand was lower this year compared to the same 4-week period last year, but I really think that's irrelevant. If you look at the situation 1 year ago, many of you who live in the northeast part of the United States will remember that we had a bit of a cold snap towards the end of the heating season last year. Sort of the mid to late March period, and that cold snap drove extreme heating demand for that time of year. The Northeast accounts for the vast majority of all heating oil consumed in the United States in terms of heating oil. Therefore, that cold snap caused demand to be unusually high in the 1 year ago period. So I really don't think that's much of a comparable. Generally speaking, my opinion on crude oil remains unchanged over what it was last week. I think these numbers are becoming a slightly more constructive, both on the demand front and on the inventory front for both crude oil and gasoline. Inventories are still relatively well supplied for this time of year. There's really no fundamental reason for oil to be rising as it has been, other than, of course, the currency adjustment. The U.S. dollar declining in value against most other major currencies can be accounted for most of the increase in crude oil prices we've seen actually so far in 2008. Things to watch would be, Do we continue to see a drop-off in crude oil imports into the U.S.? That could help tighten the demand picture a little bit. Also, do we see the refineries remain disciplined in terms of their output of gasoline? In other words, do they keep that capacity utilization low, bring those inventories under control? That could provide some upside for refining margins and also for gasoline prices and gasoline use. The other factor, of course, is the demand front. I'd like to continue to see demand remain at least stable, if not uptick a little bit, and that would be, of course, supportive for crude oil and gasoline. Once again, though, I would reiterate yet again this week that tomorrow morning, same time, same channel, we will actually be looking at the natural gas inventories. I still think natural gas is a far, far more interesting market for investors to get involved with. Specifically, I do see those inventories coming down under the 5-year average over the next 3 weeks as we come into the end of the winter heating season. Thank you very much for joining me today.